Hi, I'm Ben Clark, Portfolio Manager at TMS Capital, and thanks for taking the time to watch this presentation today. I'm going to be talking about our high conviction fund that we've been running, what we think about the market, what we've been doing in this market, and some of the key features of this fund. I'll get straight into it. Who we are. TMS's background is we've been managing money on behalf of high net worth individual and family offices for over 16 years now. We currently manage around $650 million. Our firm has grown pretty consistently over that time in a pretty tricky period for the industry widely. And one of the key sort of things we reckon has driven that strength has principally been good performance that we've offered to our clients. So we felt it was a natural progression to try and create a different structure that other investors might be interested in and apply that investment expertise that we've been building up over a long period of time into a fund. We believe our background, which is kind of unusual in our industry, gives us a bit of an edge over the market. There's some ways that we were brought up investing, and investing for private clients is a different beast to investing coming through a funds management world. And we believe that some of the lessons that we've learned over time have aided the success that the fund has had in its early years. I'm the lead portfolio manager of the fund. I've been working at TMS for 15 years and in the industry for 20 years. So how do we think about investing and what have we been applying to this fund? The basic relationship that we believe really drives long-term share price performance is a rising profit per share. It sounds pretty simplistic because there's a lot of jargon out there in the industry and a whole lot of terminology about the things to look for and what's moving the markets on a day-to-day basis. But our view is if you can find businesses that can meaningfully and consistently grow their earnings per share over long periods of time, share prices are accurate at tracking that profit trajectory. There's some key attributes that we look for that we believe will add to a company's ability to garner that rising EPS. Firstly, we like to find companies that have got really experienced, driven, long-term management teams. Ideally, the management teams are heavily invested in the company themselves and they want the same share price outcome that we do as investors. We look for businesses that are harnessing very high returns on incremental capital. Ideally, that they're investing aggressively back into their company and making the most of those returns on invested capital, which will see an acceleration of the underlying EPS if that's well done. And we're also active, and we believe we can add some long-term outperformance across our portfolio in skimming some of the holdings that we've got when we believe that the share price is somewhat disconnected from the underlying profit trajectory, or adding to the share price when the opposite has occurred. We like companies that have got long-term structural tailwinds, and when it comes to the long-term thinking that I was discussing earlier, I think a good statistic I put in there is that of the 21 companies we currently own in the fund, 13 were held at the fund's inception 5 years ago. And I think that would be a really rare statistic for most fund managers in such a tightly held portfolio of stocks. So let's look at what this looks like in practice. ResMed is our largest holding. It's been held since the fund's inception. And what I've shown in the graph here is that the white line, which is the underlying earnings per share forecast from consensus analysts in the market, and you've got the green line, which is the share price of ResMed. And what you can see here is sort of what I was discussing, is that in short-term periods, there has been a real disconnection between what the share price of ResMed has done and what the core earnings per share trajectory is doing. And that can provide shorter-term trading opportunities. But in the longer term, the market is incredibly accurate at tracking this underlying profit per share. So if you can find, and if you can just concentrate on finding these businesses where you believe they can do what the white line has done here, our view is the share price will look after itself. I've made a comment in the chart that we feel our edge over the market it can be condensed down into two things: time and discretion. Time is taking a longer term view on stocks, not worrying about short-term tracking error, what various benchmarks are doing, but really focusing on what the core businesses that we own and what their future profitability is going to look like. And discretion comes back to this probably slightly more unusual way that we've come into this industry, where we take an approach that if we don't like a certain sector, we just won't own it. We won't go underweight it, we just won't own it. And we don't worry too much about what percentage of a benchmark an individual stock is versus our holding weight. We try and find the companies we think have got the highest probability of achieving a rising earnings per share, and we'll take meaningful positions in them if we feel that they look good. I've made a few additional comments in the chart about when we skimmed and added to ResMed over the 5-year period. There's been 7 times that we've skimmed a bit of money or put a bit of money into it. So how have we performed? We started the High Conviction Fund as a shadow portfolio 5 years ago. It outperformed the All Ords Accumulation Index by 4.4% in its first year, which is when we put our own money, some family and friends' money, and some key clients of our firm back the fund. In the 4 years that the fund has been running, we've returned 15.2% per annum after all fees, which is more than doubled the underlying benchmark's return, which is the All Ord Accumulation Index. In good markets, it generally is, most fund managers are doing pretty well. Some are doing better than others, but it is hard to assess how much risk different fundies are taking on in order to achieve the returns in the good markets. And what I've been particularly pleased with is how we've gone over the last year, which was a highly turbulent year, a difficult year, and this is normally a time when risk gets shown out. And for us to have delivered a return of positive 13.7% after fees versus the index's negative 7.2 was definitely a highlight of the history of the fund. In the following chart, what I've showed is how the fund's trajectory has gone versus the underlying index, the All Ord Accum. Now, I just wanted to put this in because generally when you're doing these sort of presentations, you talk about what you've done right and where you think the markets are going, all of those sort of things, but you don't often talk about what can go wrong. And if you look at the history of how the fund has performed, you'll actually see in the sort of mid-2016, for about a year and a half, we did underperform the market, and there will be periods where we underperform the market again. Now, what happened back then, of course, was Donald Trump won the election, which completely wrong-footed everyone. It wasn't priced in. And we saw this huge rotation of capital out of what we would see as the higher quality growth stocks into some businesses that really rely on either rising interest rates or stronger economic growth to grow that earnings per share and hopefully to see rising share prices. So we went through a period where a number of our core holdings were sold off to fund that trade. But since then, as the market has realised rates will not be, of course, going up anytime soon, and the economic growth outlook has petered out, we have seen a good return to form. So what's our current view? Well, it hasn't really changed since we started the fund. 5 years ago, we were coming out of the GFC, the European debt crisis was fresh in everyone's minds, and our view was that globally growth was going to be very hard to come by and was going to exist at much lower levels than we'd seen historically in the decades prior. Now, the coronavirus has only accelerated this theme in our mind. Central banks and governments are running out of tools in their toolkits to try and engineer growth, and it is going to be a period going forward, we believe, where there's going to be much lower levels of growth than we've traditionally been used to. Where this is impacting on the ASX is that a lot of listed businesses, particularly in the blue chip area of our market, are heavily reliant on some form of economic growth to grow their profits. So we think the returns of the index as a whole are going to be muted. On the back of this, we think it's even more important that you're in businesses that can grow their earnings per share organically regardless of the economic environment, and that these businesses may trade on much higher multiples than we've seen in past years. We also think there's some opportunities in some of the businesses that have been impacted by the corona issues, where the market might have got overly negative on what the earnings recovery looks like, and the reporting season will be a real bellwether for this in August, the upcoming August season, where we think there could be some real opportunities to get into some new businesses. So how are we currently positioned based on that backdrop? We are high conviction by name and high conviction by nature. We only own 21 stocks, and 42% of our portfolio is invested in just 5 of them. So it comes back to that discretion that I was talking about. We have the discretion to build large positions in companies regardless of what their index weight is. Our cash weighting is 11%. I wouldn't read too much into that. We typically fluctuate between 5 and 15%. We don't profess to be able to call markets, short-term direction. We really like to focus on the businesses that we own. The recent changes we've been making to our portfolio can be seen in three things. Firstly, we've been looking at some companies that we think have been impacted by the coronavirus and the earnings recovery might be faster than expected. So two examples of these are Tyro Payments and Sydney Airports we've been buying. We've been adding to some of our more defensive growth stocks. There's been bouts of selling in these companies over the last few months as fund managers who have been sort of wrong-footed by how quickly the market has recovered have been getting out of some of these businesses to fund a rotation into the more cyclical growth businesses. And we've used the weakness in some of those defensive growth stocks to build our holdings. CSL, Xero, ResMed and Fisher & Paykel Healthcare would be examples there. And we've been skimming some holdings that we think are very strongly re-rated post-COVID and are now looking more fully priced, although we continue to hold core weightings. Appen, Afterpay and Seek would be three examples of these stocks. How do we charge? We think we've got a very competitive fee offering which is very aligned with our investors. Our base fee is 0.7% plus GST, which is fairly low by industry standards, and we charge a performance fee of 15% plus GST over the All Ords Accumulation Index, which we believe is the fairest index that we should be measured by. It's the index that you can get exposure to through an ETF. There is a high watermark in place where a performance fee can only be earned if the value of the investment is rising in value. We have a minimum of $100,000 as an investment for those who meet a wholesale/sophisticated test and $500K for those who don't. I've been terming this as a fund as I've been running through this presentation, but the structure of the fund is actually what's called a separately managed account or an SMA. There's some real benefits to direct investors through this structure. Principally, you actually beneficially own all of the stocks in an SMA. You get the dividends, you get the franking credits, you can actually see the portfolio you own. You're not influenced by other investors' behaviour in the fund because if they were to sell their fund, the fund manager, rather than having to sell some of everyone's shares, will only sell their small portfolio. So we think there's some real benefits of an SMA, particularly to retail-based clients. So in summary, why invest in our fund? We believe we truly stick to our knitting and we practice what we preach. Our performance is going to differ significantly to the index, and that can be an advantage. If you're looking for uncorrelated or less correlated returns to the market, our portfolio looks very different to the market, and over time it will behave differently. There is a strong alignment of interests with the managers. We're heavily invested in the funds personally, and we believe our fee structure is giving investors access to something which they'll only be paying fees for if they're performing strongly. And finally, we have over time built up a track record of significant outperformance within the fund. And although there's no guarantees we can continue that into the future, of course, we'll be trying our best to. I put our contact details here, and there'll also be a contact tab on the Livewire website. Thank you so much for taking the time to watch this presentation. I hope it's been helpful, and good luck investing.